morning, good day, and good evening. My name is Theto Morifi, and I will be walking you through a few basic principles regarding the Elliott wave theory. Right, so the Elliott wave theory is a trading strategy, technical analysis strategy used to analyze the markets. Okay, so I've taken a bit of time, and by a bit of time, I'm talking about years, to become fluent in speaking this language specifically. First of all, I'd just like to start off with a quote by Johann Wolfgang. And that quote says that the limits of my languages are the limits of my universe. And what that basically means is that information allows you to grow. Information allows you to expand your horizon. Information um, sets up sets you up for success, basically. Right. So without taking much time, let's just get right into it. So before we could start any theory, we need to understand how it came about, right? And I'm just going to talk a little bit on the background of the Elliott wave theory. And how it came about was by a man named Ralph Nelson in the later 1930s. And this was just after the 1929 90% market crash that was not anticipated by the market analysts of that time. And this specific phenomenon was what caused and sparked the strategy and the journey that Ralph. So this was the Elliott wave theory is a mathematical strategy that will both read and predict and anticipate projected destinations based on the notion of repetitive patterns created by the market, right? So Nelson plotted, he took many years to do this, but he plotted um, charts on graph paper by hand for years. And he came to realize that the market always moves in waves of fives and threes, mainly five waves being impulse waves and three waves being correction waves. He then discovered that there are varying complexities in the Elliott wave count, as there are always multiple degrees of waves operating simultaneously. And by degrees, we're talking about levels, meaning that one part makes up another part, makes up another part, makes up another part. All right, we'll get into that. Don't be too intimidated or scared. So these degrees of wave counts are determined by time frames. Okay, the higher the time frame, the greater the degrees of waves. The lower the time frames, the lower the degree of waves, so on and so forth. I think you're with me right now. So let's understand the principle. The wave principle is broken down into two major categories, right? One, motive waves. Two, corrective waves. Motive waves is just another synonym for impulse waves. And then corrective waves, we've covered that before. Correction waves, three waves as well. So now motive waves are impulses or impulsive waves. And they are made up of a five wave sequence. Wave one, two, three, four, and five. And these waves happen very quickly. So generally they take up a shorter period of time to start and complete, right? And corrective waves are made up of three waves structures, A, B, and C. Keep that in mind, right? Have a note and a pencil and a pad, and write that down. One, two, three, four, five, impulse waves, A, B, C, correction waves. These waves are generally slow and sloppy, and you find them in a rectangular motion and rather not a linear motion. So latitude rather than longitude or altitude. Okay, and they're mostly chunky, so they're very easy to spot. If you can't spot impulse waves, just look for the correction waves. Very easy to spot. So right now we're just going to look at a few examples of what impulse waves look like and what corrective waves look like. So if you just um, attract your attention to the right hand side image figure, you will see that I have illustrated in a diagrammatic manner how impulse waves look. So as you can see, we've got an impulse wave 1, 2, 3, 4, 5, and we've got an impulse wave 1, 2, 3, 4, 5 on the right hand side. Now I want you to notice how they look a little bit different but similar Okay, and now I want us to look at corrective wave examples. Remember I said ABC, right? So we have different types of varying complexities of corrections, just like we have different types of varying complexities with impulse waves. Okay, so this is a layer that I'm going to get deeper into at a later stage, but for now, I want you to understand the difference between an impulse wave and a corrective wave. Notice how the impulse wave goes straight up or straight down in the opposite sense and happens very rapidly so. And corrective waves take a longer time to happen and they predominantly move in sideways directions. Okay, so now why the Elliott wave strategy? Why do I love it so much and why would I recommend it so much? Because, well, for starters, the Elliott wave helps you identify trends in the market. It helps you identify counter trend moves in larger trends, and it helps you identify the maturity of the trend you're in, and it provides key invalidation levels. Now, I just want to unpack a few of these so that you understand precisely what I'm talking about. When I talk about helping you identify the trend in the market, you know whether or not you're in a correction or an impulse move. And that kind of tells you whether or not it's safe to enter a trade or not. That alone is very key. You need to know whether or not you're going to jump in into a trend or sit this one out. Yeah. And it helps you identify counter trend moves. Now, what are counter trend moves? Counter trend moves, counter meaning against, and trend meaning the flow of movement. So against the trend or against the current. All right. So when I say it helps you identify the counter trend moves, these are talking about the corrections. When you know how to spot corrections, you were able to pinpoint when and how you will be able to anticipate the next impulse move or the next rally in the trend, the next strong move. So it's very helpful in that sense. And it helps you identify the maturity of the trend you're in. You don't want to hop into a late trend. You don't want to get into a trend at the very last minute when everyone else is jumping ship and the trend is about to fall, right? We want to enter the trend at the earliest convenient moment because that's what we want. We want to be safe, we want to protect our capital, we want to grow. So when I say it helps you identify the maturity of the trend, remember we have five impulse waves. One, two, three, four. One, two, three, four, five. Okay? And in that impulse move, two are counter trend moves and three are impulse moves. Waves one, three, and five are impulse moves. So what we want to do is we want to enter at the end of wave two and at the end of wave four. So we want to enter at the end of wave two and at the end of wave four. And understanding the maturity of the trend, if you want to enter at the end of a wave five, something is going to happen to you and it will not be nice. Meaning that you will enter the trade at the very last minute, everyone is jumping ship, the trend is going to change direction and you're going to lose out heavily, right? So what we want to do in the number four, the Elliott wave theory allows you to see key and invalidation levels. And what invalidation levels mean is that um, it allows you to understand very early on when a trade setup has failed. Okay, so if the market reaches that specific level, then price and strategy, the price action tells you that the strategy or the setup you had has failed and you need to reconsider or reevaluate, take a step back and relook at the market structure to be able to identify whether or not you need to change your perspective. whether or not you need to change the direction of your analysis, or simply make an adjustment to the current structure to accommodate for that invalidation and to put you in a more clearer perspective. Okay, so if we're looking at a full wave cycle of the Elliott wave, we're talking about 8 waves, remember, 5 and 3. So a full wave cycle would be an impulse move followed by a corrective move, and that is 8 waves long. 5 impulse moves followed by 3 corrective moves. Okay, now I want you to understand that this is just the beginning. This is just understanding the basics of the Elliott wave. This is understanding that a full wave cycle is made up of 5 waves followed by a 3 wave corrective cycle. Okay? I need you to understand that each and every single one of those waves, waves 1, 2, 3, 4, 5, A, B, C, has subwaves to it, meaning they have layers underneath that make up that one wave. As well, in the same manner, the full wave cycle, the 8 wave cycle, is a layer below another wave cycle in a greater degree. And this is when we start talking about degrees. This is when you start understanding that, okay, every single layer is a certain degree, and there's a degree lower than that that creates the foundation to that specific degree. So degree 1 sets up the stepping stone for degree 2, sets up the stepping stone for degree 3, sets up the stepping stone for degree 4, so on and so forth. So what I want us to do now is look at the waves, wave characters, and wave rules to understand what happens, how do these things really work? Because you can't just look at a chart and start looking and pinpointing your own waves, seeing the market as you want to see them. You need certain parameters, certain rules to stick by that guide you all the way through, you know. So we'll start off with wave 1. Wave 1 is not always entirely obvious when it begins, when it forms at the beginning. And in these cases where wave 1 is forming, fundamental sentiments are still quite weak, meaning you might see weak volumes, you might see weak sentiments, fundamental sentiments across the world. You might see weak readings of banks moving their money, investors flocking money into or injecting money into a certain currency. Those things might be weak as wave 1 forms, but they are slowly and gradually beginning to rise. And however, these volumes are not yet strong enough for technical traders to notice, right? So fundamental traders might have an idea of a trend changing or a trend beginning, right? But technical traders still don't have any idea of what's happening. Unless maybe you've got a foot in both pools, you might have, you know, which is always a great thing. Again, the limits of my languages are the limits of my universe, right? Wave 2. Wave 2 creates the correction to wave 1, right? But notice that wave 2 can never, and I mean never, there's no exception to this rule, can never retrace to the beginning of wave 1 or even pause it. Okay? And even in this case, when we're looking at fundamentals, right, they still haven't reached the reversal capacity of the previous trend, right? So there's still a little bit of hesitation going on, but there's a little bit of light coming through. And the volume, right? So I just want to talk about the volume levels for people that do trade using volumes. The volume levels end at a lower or higher level than they did for wave 1, depending on the direction of the trend. So, for example, if we were previously in a downtrend and this is a new trend forming, a new wave 1 forming in an uptrend, right? We expect the levels for the wave 2 of the new trend to be higher than they were for the wave 1. Okay, remember we said that in the wave 1, the volume levels are still a bit weak. So in this case, they're going to be a little bit higher, indicating a possible influx of buyers. So now we're going to talk about wave 3. Now wave 3 is usually the strongest wave in the 5-wave sequence. And again, let's just take the stance that we're talking about an uptrend here, right? So it's usually the largest and the most powerful wave in the 5-wave move. And the fundamentals in this case have caught up strength in the direction of the new trend. So if we are looking for when the safest time to enter the market or enter the trend would be after the wave 1 and 2 have formed. Okay. Sometimes, this is a key word. As wave 3 breaks waves 1 high, or low, but we're focusing on high now because we're talking about an uptrend, right? There may be market gaps experienced. Should this be the case, it then serves as an indicator for wave three's rally. So if there's a market gap, it's a good thing. It's a really good thing, especially for us, because then we know it's a confirmation. It's a clear, rock solid confirmation that wave 3 is happening and we are in it. Let's talk about what happens after the wave 3. Remember, wave 3 is very powerful. So the market expended a lot of energy forming wave 3. It needs to rest a bit. So then naturally wave 4 would be the correction wave after wave 3. It's usually a shallow retracement, okay? But I'm just going to speak to this a little bit later on. I want to show you something. And this is why I really recommend a lot of practice with the Elliott wave theory, because you learn a lot more through practicing than you do in theory. Okay? And this is the point I'm going to give you after this is an experience point. So wave 4 is usually a shallow retracement of wave 3, and I'm going to talk about the Fibonacci retracement values later on, and those are going to really put everything into perspective in terms of value for those who are mathematical. More sentimental traders are entering the trend in the direction of the new form trend and buying or selling the fourth wave pullback. So in this case, a lot more people want to enter the trend at the fourth wave. Okay, a lot later than when we would have entered, understanding the Elliott wave theory. However, the volume levels start to decrease and fall shorter than those of the third wave. And to put this into perspective, what this means is that now we have less people jumping onto the trend than they did in the third wave. Okay, so that's what it talks about. Now, I just want to go back to that point that I said I'm going to talk to you about regarding an experience point. Wave 2 and wave 4 rarely share the same corrective structure. By that I mean wave 2 and wave 4 almost never look the same. One is always shallower than the other, or one is always deeper than the other. Okay, one may be longer than the other, one shorter, so on and so forth. Okay, but now let me talk about wave 5. Wave 5 always moves past wave 3. Okay, or in one case, it may not move past wave 3, but I'll talk to you about that as well. Sometimes wave 5 can be extended. Okay, extended being elongated. It might be a little bit longer than wave 3, but wave 3 can never be the shortest wave in the 5-wave sequence. Wave 5 can also truncate. It can also fall short. So wave 5 can also truncate, meaning it can also fall short of wave 3. Okay, and these are rare cases, and by rare I mean probably once in like 2 years, depending on the time frame again that you'll be looking at. But fundamentals at this point are universally supporting the direction of the trend. Okay, And because levels are lower and weaker in terms of volume in wave 5 than they were in wave 3, we start seeing a little bit of some divergence. Okay, those using technical indicators like the MACD, the RSI, normal volume readings, you start to see the volume levels dropping while the chart on its own is rising because wave 5 is an impulse. That is the divergence. Okay. So this kind of tells us that, okay, a lot of more people are they're changing the directions of their signals. Okay, so now this sets or starts setting up the foundation for the first wave in the correction, which is wave A, in a major correction. Now we've spoken about the smaller corrections being wave 3 and 4, and 2 and 4, but now we're talking about a big correction, a correction for the entire impulse wave. Okay, the correction for the entire 5-wave move, which consists of waves A, B, and C. So wave A corrects wave 5. Okay, I hope you're still with me in that. Wave A corrects wave 5. And fundamentals are still rallying, meaning the fundamentals are still pushing in the direction of wave 5. But now the volumes are beginning to strengthen a bit in the opposite direction. Okay, so if they were green, they're now red. Okay, in the opposite direction, signaling a possible increase in volatility. Now, wave B corrects wave A. So in the case of the correction structure A, B, and C, wave A is an impulse in the opposite direction of the major trend. Wave B is a correction to wave A. Okay? So wave B moves in the same direction as wave 5. So if wave A was moving down, wave B will move up. Okay? And it's a correction of wave A. In this case, or when this happens, when wave B is formed, fundamentals are losing strength. Fundamentals are beginning to weaken, all right? And technical patterns start to form, such as double tops, head and shoulder patterns, etc., etc. Again, so now volumes are now higher or lower than that of wave A. So if wave A volumes were high, in this case, wave B volumes would be lower, so on and so forth. Talking about wave C, again, wave C is exactly like wave A. It's an impulse wave, all right, in the opposite direction of the major trend. Wave C impulses after wave B. Because the C leg is always a wave, a 5-wave move, volume begins to pick up in the third leg of wave C, just like how we saw in the third leg of the 5-wave move, remember. And in most cases, wave C can impulse to the price territory of the 4th wave in the major motive wave move. Sometimes it even surpasses it, goes into the 3rd wave territory, sometimes even the 2nd. It all depends on the strength of the correction. Now I want to talk about the Fibonacci ratios. These are mathematical principles. It was a mathematical principle system that was derived that houses the 61.8% ratio or Fibonacci ratio that deals with ancient mathematical principles. Basically, the golden ratio is what it's called. So I just want to talk about the Fibonacci rules. So Fibonacci rules are is a mathematical concept that has been derived by ancient mathematicians. All right. The Fibonacci rules also include the 61.8% golden ratio. which speaks about how life revolves around a specific number. That if you divide something by 61.8 over and over and over, you will receive a perfect spiral each time. Okay. Things like how roses um, develop their petals perfectly each time. They have the 61.8 ratio genetically encoded within them. So, applying that mathematic ratio to the market seemed like a viable and very powerful instrument to be used. So we have different other Fibonacci percentages as well. It's not just 61.8, but it receives more priority than other ones. Right. So wave, I just want to talk about how we can tie in the Fibonacci percentage and 88.6, or in some cases 90% of wave 2 can never retrace the beginning of wave 1. Wave 3 extends to 161.8 or 261.8, sometimes 361.8% of wave 1. Wave 4 retraces from 12.7% to 38.2%, and sometimes, in rare cases, 50% of wave 3. Wave 5 is 100% to 161%, 61.8% of wave 1. Wave B retraces between 80 and 90% of wave A, sometimes 61.8%. And wave C extends to 100% of wave A in some cases, even more than 100%, but rarely ever 161.8%. And what speaks about is that if you receive 161.8% extension of a wave A, you are most likely looking at a wave 3 instead of a wave C. Okay, so these important rules are of paramount importance. I cannot stress this enough because these are what guide you on whether or not you're looking at the right thing in the right way. Okay, so now I just want to talk about the different structures that are accommodated in the corrective structures. Okay, we spoke about varying complexities to the Elliott wave system. Varying complexities include different patterns that are found in the Elliott wave structure in the 8-wave cycle. Remember, Ralph Nelson spoke about this theory being derived from repetitive patterns in the market. So these patterns have been consolidated, have been identified, and have been named in certain bundles and collections to help us be able to apply the principle of the Elliott wave system to the market. All right. So the zigzag is one of the corrective patterns that form the ABC structure. Okay. Now I need you to remember that I spoke about different degrees setting up the stepping stone for the next degree. Okay. So in the ABC structure, or the ABC corrective structure, we have one impulse, we have followed by one correction, followed by another impulse. Okay, being A, B, C. Right. Wave A consists of 5 impulse waves. Right. 1, 2, 3, 4, 5. Wave B consists of 3 waves. Corrective wave A, B, C, which corrects wave A, followed by a last impulse move of 5 waves being wave C. Okay. Wave B is usually, so now wave B is usually between 61.8% and 80% of wave A. Okay. We're going to look at the regular flat now. Regular flat. This is an ABC structure, corrective structure, that follows the 5-wave impulse move as well. Okay, wave A instead of 5 waves, now consists of 3 waves as subwaves, A, B, C. Okay? Wave B is also a corrective um, structured wave, which is ABC as well. Now, I know you might be confused by saying, okay, why is there a correction followed by another correction followed by an impulse? Shouldn't be an impulse, correction, impulse as we have learned thus far. Well, this is a pattern on its own. A regular flat is a pattern on its own. Therefore, it means that the pattern on its own consists its own criteria of rules that need to be adhered to. Okay. So whether or not the general notion speaks about an impulse following, I mean, a correction following an impulse, we need to understand that these are made up of a series of smaller components or smaller patterns that allow for us to, that give us rules to follow. So wave C is an impulse move. And now in this case, generally when we have flats or regular flat, B or wave B usually retraces to very close to the beginning of wave A. Okay, so it's a very deep correction. All right. And that's why it's called a flat, because it's generally a very rectangular corrective move. And another correction pattern we have is a triangle. Now, a triangle might be the most confusing out of all of them because the subwaves are all just 3 waves long. They are all just a bunch of ABCs, ABCs, ABCs right next to each other. Okay, so, but it might be the most distinguishable pattern of the most because now, if you have a bunch of ABCs which are very clear in the market space, you already know you're dealing with a pattern and you can already take the steps and the measures you want to work along with. All right. Generally, to be able to understand the difference between a triangle and something else we call a diagonal, you need to understand that the lines converge in a left to right direction. Diagonal lines converge in an up and down movement, and diagonals happen in an impulse rather than a corrective structure. Okay, so this is where we're going to wrap it up for now. These are the basics. Okay, and the Elliott, I just want to close off with another quote. It says, the Elliott wave principle is a tool. A knife in the hands of a skilled person can save a life. But the very same knife in the hands of a lunatic can take a life. Use it well, apply it well, practice it well, and you shall be well off. J. Kennedy. And that's it for me, Theto Morifi. I'd love to hear your feedback. I'd like to hear your views on this. Tell me if it was a bit monotone. Tell me if it was a bit long. I don't mind, you know. Um, Everything is a learning journey. It's a learning curve. And we're here to better ourselves, improve ourselves, teach ourselves something new, learn something new from others as well. And if this was a daunting journey for you to take, please trust yourself. Be patient with yourself, but most importantly, learn to love the process because it will build you overall as a person. Take it from me. Until next time. Cheers.